Hello, everybody. Thank you guys all so much for taking the time to be on our financing webinar this evening. Looks like we have an awesome turnout so far. As people are coming in, I am just going to do a quick intro on the financing presentation we're going to have tonight. So, as many of you know, interest rates have been a standout headline in the news recently. And I'm excited to have Reed on our webinar tonight to be able to cover that and update how we can best navigate the real estate in purchases in 2022. So in a few minutes, I'm going to be introducing our preferred lender, Reed Hazard from CMG Financial. So Reed and his team have been a critical part of our growth for Marshall Reddick and have helped thousands of our clients obtain financing for our purchases, as well as leverage refinances to expand portfolios. So for those of you that are unfamiliar with Marshall Reddick, this is always a good time to explain who we are and what we do. So I wanted to quickly go over our services. So I would explain us as a full service real estate firm, and we have 4 primary services that we focus on. We have our real estate brokerage, we have our property management, our private lending, and our investment funds. So for our real estate brokerage, we help people buy and sell, whether it's a primary or an investment property. For property management, so 99% of the folks that buy an investment property are going to need property management. So we offer everything from, marketing the property, doing the turnovers, rent collection, rent disbursement, any kind of maintenance request, the tax documents you get at the end of the year. We would provide all of that to the owner or on the owner's behalf. Our third service is private lending. So private lending is a very unique service that we offer where there's actually 2 clients in private lending. So we have borrowers and then we have our lenders. So the same way, for borrowers, I'll give you some example of people that borrow from us. So this is very different than the lending that Reed is going to be talking about. Reed is a conventional lender. These are the traditional loans that most of our investors obtain for financing of a long-term purchase. The financing we do is typically more short-term. So the fix and flippers are guys that are typically borrowing with us. They need money for acquisition and rehab, right? So that's an example. We do a little bit more long-term. That's mainly for folks that maybe they don't qualify for conventional. Maybe the loan is in a self-directed retirement account and you're trying to buy property for your retirement account. You would need a private loan for that. Or maybe you have more than 10 finance properties. Whatever the reason that you can't go conventional, we would be an alternative for that. On the flip side to lenders, we have on the flip side to our borrowers, we have our lenders. So the same way that you can invest in real estate, we give our investors the opportunity to invest in mortgages. So you could be the lender on a loan. So basically, instead of collecting rent checks, you can collect mortgage payments. So you can fund those loans directly, or as we segue, this kind of ties into investment funds. So we also have a mortgage fund. So our mortgage fund, it basically dovetails off of our private lending, where instead of lending money on a one-to-one capacity, which is private lending, right, or direct lending is what we call it, meaning one borrower, one lender, we have the ability where we give our investors the opportunity to invest in our fund, and our fund loans money to specific borrowers at their discretion. So with the fund, you're spreading your risk amongst, multiple loans. We have almost 200 in our mortgage fund actively today. You're given a quarterly distribution and you can stay in the fund for, as long as you want. So there's a few differences there, but that's, ultimately the nuts and bolts of our services. And, my goal is to make the process of investing as seamless as possible. And I do that, by educating and introducing our key players that work with us to, make it all happen. So a quick introduction to myself. So my name is Vince Tomich, and I'm an advisor here at Marshall Reddick. So my primary role as an advisor is to learn as much as I can about each individual investor and then help guide you through the process to achieve your goals. I was born and raised here in Southern California. I've been in the real estate industry now for just over 7 years. I'm an investment property owner myself. I'm a huge fan of practicing what I preach. I talk to a lot of investors who are looking at properties, and it's much easier to draw off personal experiences and share that those conversations. Just like Reed, he's also an investor himself, as well as we've invested in the lending side of our business with loans, as well as in the mortgage fund. So that's a little bit more about myself. Let's see, we're going to go into our markets here. So we are located in 16 different markets across the country. You can see that there is a handful of highlighted cities in green. So these are all markets that we have a physical footprint in, meaning we have offices, agents, property management. So this is a place where there's a physical presence, where the cities that you see that are not in the checkbox or not in the green boxes, those are cities that we have referral partners that we lean on. If there are investors who are seeking any kind of services in those markets, truth be told, the bulk of our business is done in the cities that are we have a presence in, just to give those indication of what that looks like. And then before turning it over to Reed, I just want to quickly go over where how we choose markets to invest in. So we've taken the time to vet out specific markets we want to focus on. I think we can all agree that not every market across the US is a good market to invest in. So we put together some key criteria we feel support a strong investment market, and that includes the following, right? So we want to have a strong job market, low vacancy. It's good to have economic diversity. Housing affordability is clearly an important one. We definitely want more landlord-friendly states, strong education, and then last but not least, reliable property management, which I can't speak enough about. And as let's go. All right, so now I want to bring up Reed. Sorry, let me back up a slide here. Let me just this will give you a little bit more of Reed's background. So I'd like to introduce Reed Hazard with CMG. As I mentioned earlier, Reed is a pivotal part of the success of Marshall Reddick clients, and I've worked with him on countless transactions. Reed's market knowledge and experience has been a driving factor in our success and in his success. And we as a team rely on him heavily to navigate the ever-changing market. Now more than ever is such an awesome time to be able to get Reed on a presentation and go over what we're seeing right now and what to expect, for the rest of 22 and potentially early 22 and 23. So Reed, whenever you're ready, you can take it away.
Awesome. Thanks, Vince. And thank you to Marshall Reddick for having me on. And yeah, wow, I'm just going to say it. It's just been a crazy year. And really, pretty amazing decade when you look at all the wins. And, this past year, we just had a lot of curveballs thrown at us. Obviously, the Fed really, really trying to slow things down. So I'll try to dissect some of that tonight. Very hard to put a forecast out there, but I think we can definitely look at a lot of data, and we're going to do that tonight. And then we're also going to go through like how we're navigating this market. So yeah, that's just a little bit about me on the board. I've been doing this for about 18 years now. So I bought my first property when I was 19. I just never looked back. Just love what I do. I love the power of real estate. And yeah, again, just very, very fortunate to be on the call tonight. So what we're, obviously why CMG? I just want to put that out there first, just for the company that I work for. We are navigating this market just amazing right now. There's a lot of mortgage companies that, their volume in the industry is down about 80% right now, year over year. So that's definitely hurting a lot of companies. My company has 6 income streams. So we're a loan servicer. We have a large retail channel. We have a wholesale channel. We have a correspondent channel. We have a brokerage channel where we have our own broker dealers. So there's CMG Securities. We actually fund our own money, securitize the loan, service the loan, and then have the ability, to sell those loans to the GSE. But we're actually holding a lot of our loans right now as well. And then we have joint venture, where we've ventured and we've partnered with different real estate groups over the years. There's multiple different groups that I can think of that are pretty large companies that my company is partnered with. So there's just a lot of income coming in from different areas where we're able to lose money on the front end on retail, to be able to keep our pricing sharp, and really to be able to navigate this storm that we're in right now, where we have interest rates that are more than double where they were at just earlier in the year. So again, some of the things about us that really stand out: licensed in all 50 states. We specialize in investment property financing. We have a program called the All-in-One program. It's a first lien position home equity line that you can draw on for 30 years, and it actually ties to your checking account. So your incoming balances throughout the month into that checking account will go against the loan that you owe on your All-in-One. So the product is just fascinating, allows you to operate like a bank. So I'm going to talk a little bit about that tonight, and that product was created by my company in 2005. Obviously, just a very large bank, so we funded about $38 billion last year. 70% of that is purchase. So this company is just built to last. And you get the big bank rates, but you get the personal service with me and with my team. We really try to make you feel like you're our only client. And I do still work with all of my clients on the front end. So dealing with the interest rate, answering phone calls, guiding you guys. If you're going to 1031 exchange into multiple properties, you're strategizing with me on the phone, but I've got a great team that handles all the documentation for us. And then one other thing that I want to mention, my company's coming out with a refi incentive right now. Because we service so many of our loans, meaning that after your loan closes, we're the bank that you make your payments to. We're putting in a refi incentive plan where if you purchased a home in 2022, we will cover the cost of your refinance in the future. And frankly, why we're doing this is because we want to retain all of our clients. It's also because, the company believes that the loans we're doing today will be refinanced in the future. So, the general banking industry does believe rates will come down again at some point in the future. Can't really put a day on that or even a month on that right now. But again, if the loan is done in 2022 and if rates come down in 8 months and you go and refinance somewhere else, the company loses money. So not only do they want to keep you happy, do they want to earn your future business, but we are very motivated to keep your loan. And if the rates get better and we can refinance you in the future, if you did your loan in 2022, you will literally pay zero cost for it. So my company really stepping up to the plate on that. I was very stoked to hear that. Some of the info that I'm going to be covering tonight, getting pre-approved, what does that consist of? Best loan programs available for buying a primary residence or an investment property today. How are we getting creative? I'm really going to cover that. And we're getting creative in, quite a few ways. Private financing options. So if you can't qualify for conventional financing, Marshall Reddick has the best private financing out there. So I'll be covering that on a few slides. And then market update. What is happening with interest rates? And just kind of a discussion on really what's to come here over the next few months. So, you guys getting pre-approved, why is it important? It allows you to confirm your max qualifying power. Learn how current interest rates are affecting your monthly payment. If you're looking at homes 3 or 4 months ago, if you're even looking at homes 2 months ago, just the lending environment has changed. So getting an updated pre-approval, getting, updated on what it's going to look like buying a home right now, based on the down payment that you have and based on the payment that you want. That needs to be dissected right now. The market's changed quite a bit over the past 90 days. So again, it just allows you to pinpoint your purchase price to the payments that you're comfortable with. The industry says you want to, marry the property, date the rate right now. I think no matter where rates are at, you always want to marry that property, especially if you're going to live in it. Through the last few years of interest rates being so artificially low, I think people were really settling on anything they could get at near the end of that. Whereas now you do have more options. So really marry the property right now. And then again, you may be able to refinance in the future when rates go down, which is great. Organize your plan. So why else it's important to get pre-approved? If you're going to 1031 exchange, so if you're going to take equity from one property, maybe you have a few properties in markets right now that are not really the best markets, but you could sell for a much higher price than you paid, and you can move that equity maybe into a better market. I have buyers that are 1031 exchanging, selling maybe a luxury property, taking a few $1,000,000 and literally buying 9 or 10 properties at the same time in multiple different markets. So no matter how complex that your plan is, just getting pre-approved, to be able to build your plan and then have no hiccups later, and then know what the numbers are going to be now, so that there's really just no surprises. That is the biggest reason why you're getting pre-approved in this market. So the process to get pre-approved, I wanted just to break it down a little bit more deeply today. So you would go to my website at reedhauser.com. You click on the Apply Now tab. We would get your application. We're going to ask for the 2 most recent years of W-2s, 30 days recent pay stubs. If you have multiple properties, and if you have if you own a few companies, or if you own a company, you'll need to provide tax returns. If you're W-2 and you have pretty simple income, we don't really need tax returns to qualify. So just depending on your application, we're always going to request the items after we get the app, and then we'll work on getting a limited amount of documents from you. But yeah, assets, we'll need the 2 most recent bank statements for the accounts that you're going to use for your down payment and closing. Copy of a mortgage statement and insurance declarations page for any properties that you currently own. And then after we get these items, my team will run your loan through the automated underwriting system to get an approve eligible. Another big reason why you do want to get pre-approved and not assume in this market is the Fannie Mae Freddie Mac DU underwriting systems. When we run your loan through their system, we get back an approve eligible, or we get back a refer eligible, or we get back a deny. And so depending on what we get back, it's going to tell us what else we need to provide. And we're starting to see those systems become more conservative, and that would make sense, right? We're not seeing credit deteriorate right now. We're seeing, borrowers by and large making their payments on time. The average credit score in the nation is still very high. It hasn't really dropped much. It has not dropped by much, but the amount of consumer credit is definitely growing. And we're, again, we are already seeing more conservative lending guidelines being put into place. So, make sure that you qualify. If you have declining income year over year, even if it's a W-2 job and now your income is, 10% lower for some reason, things like that are going to have to be explained. Whereas the past few years, if DU accepted it and you were W-2, it was no big thing. So again, just be aware that lending guidelines will tend to get more conservative as we go, and I think it's going to be that way until we just get more clarity on the future direction of things. So by going through this process, it would represent a pre-approval, and it'll get you prepared to write a competitive offer. We've done 15-day escrows, you guys. We've been able to close loans in 2 weeks. We don't do that often, but the average, if you want to place an offer right now and you want to get a deal, right, you want to go in significantly below asking price, right? You see a property on the market and it's been on the market 70 days, you want to get the best deal possible. If you write that offer and if you're not prepared, and if you can't close quickly, a lot of times they're going to go, sure, you know what, fine, we're going to accept this, but, we need to close in 21 days. You need to be prepared to be able to do that. So I think if you're buying in this market, there's always going to be opportunity in every part of the real estate cycle. But definitely, you want to get a deal. So get prepared. After you get pre-approved and just throughout the process, people that are more sales facing that you'll know and speak to is Mike Lynch and Jessica Yinger. You'll also talk to Lee Warnick. So they mainly handle Marsha Reddick with me, and they're just fantastic. You'll really, really love working with them. Mike's been an underwriter, his underwriter background for almost 30 years, and Jessica's been in lending for over a decade. So I work with people that just know their job very well, have great customer service, and again, answering our phone, on evenings and weekends, that's what we do. Yeah, so just, the days of, a borrower just taking your application or a lender taking your application and spitting out an approval letter, it's just, if you really want to place an offer in this market, it makes sense 100% to go through the approval process. Even if you're not going to buy for 3 or 6 months, I really think it does make sense to see what you qualify for and what those numbers look like. But again, if you don't want to buy for 4 to 6 months like I have on this slide, or even a year, and you just want to do some planning to find out, hey, Reed, how much income do I need to claim on my 2022 taxes to be able to qualify? I'm self-employed. I made more money in 2021 than I made in 2020. I'm having a great 2022. I want to buy a house for $600,000. How much income am I going to need to claim? Right? So then we'll request a copy of your draft returns before your CPA files. Don't have them file, but we'll have them, send that to us in, January or February of next year. And then we'll tell you what you have to work with. And then you can structure filing your taxes with enough income to qualify, but also not, just claiming no write-offs where now you're paying a lot more taxes. We can help you fine tune that. So if you don't want to run credit yet, if you don't want to do a full pre-approval, that's totally fine. Mortgage planning is great. But if you want to get out there and execute an offer and you're serious about shopping now, again, definitely get pre-approved, run your credit, do it the right way. After you guys get pre-approved, it's good for 120 days. And if we don't find a property in that time frame, we're not going to keep on running your credit. We will hold off on doing that until you find one. And then, after I get pre-approved, what if I want to buy, more than one property at once? Like I said earlier, we can do, 1031 exchanges, for example, where we're doing multiple deals at the same time, located in multiple different markets. So if you want to buy 2 at once or 4 at once or 6 at once, we can do that. Yeah. And then after you guys get pre-approved, I always show this slide. Just don't go up and open up any new credit without letting us know. If you need to go buy something, just let us know. If it's a new car or anything like that, let us know, because your debt to income ratios could be affected by that new payment. And then if you don't qualify later, that's going to be a problem. So just be open with your loan officer. Let them know if you're going to buy anything else after you've gotten pre-approved. And then really, I always go over this slide, how are we qualifying you? I've been getting the question, Reed, rates are so high, are you starting to see zero down payment loans that don't require income again? Or are you seeing no documentation loans that only require 25% down? Are you seeing any stated income, stated asset loans where I'm stating my income and stating my assets? And, the answer is no. There's been some non-qualified mortgage activity over the past several years where there are loans that do not verify every aspect of your life like these loans do, where it's like taking a blood sample. But those loans do require a larger down payment. And to answer the question there, I've seen lending guidelines get tougher over the past 90 days. I'm not seeing them loosen, and that's a good thing. If I was seeing them loosen dramatically right now, I'd be scared by that. In fact, I'm not seeing that, though. One thing to note, too, is that 62% of all mortgages in the U.S. right now are on a 30-year fixed with a rate below 4%. Only 2% of the entire U.S. right now is on an adjustable rate mortgage. Okay? And 98% of the remaining mortgages are on 30-year fixed loans, with, again, 62% of those being below a 4% interest rate. So when you think about 2008 and 9 and 10, there was over 40% of all mortgages were adjustable rate mortgages, and many of those had a negative amortization feature. Whereas, again, there's just none of that right now. There's just been so little of those types of loans originated in the past, decade, that the market is still by and large pretty safe, and it's being controlled by the government. Not necessarily a good thing, but in some regards it is, and I'm going to go over that on some later slides here. So how do we qualify you? Based on a debt to income ratio. Everybody has a debt to income ratio on this call. We would take the monthly payment for the home that you live in. Let's just say that you rent, just for an example, and your rent payment's $4,000 a month. And let's say on your credit report you have an auto loan for $500 a month, and you have a credit card that's got a minimum payment of $100 a month. You owe $5,000 on it, but it makes you pay a minimum payment of $100. You might pay more than that. That's not relevant. What's relevant is what's that minimum payment that's required. So we would take the $500 auto loan, the $100 minimum payment on the credit card, plus your $400 rent. That's $4,600 a month. We would then take your pre-tax monthly income. Let's say you're W-2'd and you make $120,000 a year. So you have $10,000 a month of income. We would take $4,600 and divide that into $10,000. You would have a 46% debt to income ratio. For the loans I'm talking about tonight, the max debt to income ratio is generally 49.99%. Some loans you can go above that. I'm going to cover those a little later. But that's the general gist of it. And now let's say you're going to buy a new primary residence. Well, Now, when you move out of your rental, you're not going to pay the $4,000 in rent anymore. So it's going to be, what's the monthly payment for the home we're buying? With principal and interest on my loan, property taxes, homeowners insurance. Let's say that payment's $4,500. Okay, well, now we got to pay off that $100 credit card, but man, okay, we got our debt down to $4,900 a month. $4,900 divided into 10,000, you're 49%. You still barely qualify. So that's how debt to income ratio is factored into things. This is why we ask for your income and your, we need to run your credit, is to be able to find out what your debt to income ratio is. And then when you buy rental property, you can actually use 75% of whatever the rental income is going to be on that home you're buying, and you can add that onto your income towards qualifying. So many of the properties will pay for themselves on paper using that mathematical equation. Okay, so I want to discuss conventional loan programs tonight first. Why do we always start with conventional? Really, it's Fannie Mae and Freddie Mac. The government took over Fannie Mae and Freddie Mac when we had the major housing recession of 2008, and they bailed out Fannie Mae and Freddie Mac, and then the government used Fannie Mae and Freddie Mac to essentially buy back every loan out there, and then those loans became performing notes as new buyers bought those properties or refinanced those loans into payments that they could make. And over time, the government, Fannie Mae and Freddie Mac just own now most of the loans that are tied to residential 1 to 4 unit properties. So they have a lot of control in the market. They started to raise their loan limit that they would lend. It was $417,000 from 2004 all the way until 2015. And then if anybody remembers, around 2015, we started to get more wage inflation. The economy had taken many years to climb back from the recession, from the Great Recession. And we started to see employment, just get better and better. Unemployment went lower and lower. The amount of available jobs started to shrink up a bit, and we started to get just a tighter labor market overall. And as a result, we started to get wage inflation. So that's when the government started to raise their Fannie Mae loan limit. They raised it from 417 to 424, and they just kept on raising it now, and they've raised it with inflation. So that loan amount now, the standard loan amount is $647,000. They're raising that loan limit to $715,000 in 2023. So even though interest rates have continued to go up, even though the government has said that they're not going to buy any more mortgage-backed securities tied to 30-year loans, they've continued to raise the loan limit that they will lend at because they know that we've had tremendous wage inflation. They know that it's going to be very hard to turn that back around and probably not going to go back down from here. So they're still raising their loan limit to accommodate for higher prices nationally. Now, in certain parts of the market, you have high-cost loan limits, like Orange County or Los Angeles County, where the prices of homes tend to be a lot higher. So they will lend right now in 2022 all the way to $970,800 in a high-cost area. Certain areas like San Diego, for some reason, is lower, even though the homes there are extremely expensive. I don't know why they don't raise it to the absolute max like they do in Orange County and LA. But for example, in certain areas, it's a little bit lower than that, even though they're high-cost markets. But for the highest-cost markets, again, they'll go to $970,800. They've not announced an exact number yet for how high that they're going to go in 2023. But if you look at this slide right here, I'm going to share this right now. I don't know why it's on here. Well, I believe that they're going to raise it. Oh, here it is right here. All right, I skipped right past it. I believe that they'll probably raise it to $1,073,000. That's about a 10% increase. That's about what they've raised the standard conforming loan limit by. And they're already saying that in Alaska and Hawaii that they're going to do $1,073,000. So, I mean, you guys, why is that important? Fannie Mae will allow 5% down. So you can now do a 5% down adjustable rate mortgage or a 30-year fixed. In 2023, it's likely you'll be able to do that all the way to $1,073,000 sales price. So in areas like Orange County, this is why else, even though rates are a lot higher, there's tremendous demand in anything below 1.5. The average buyer has enough money for down payment, and now they're going to be able to put with 20% down or 10 or 5 even percent down, they're going to be over $1 million price point, significantly over. So, you know, if interest rates come back down too, and, you know, then you may even see us go back to normal appreciation pretty quickly. Again, not sure that's going to happen, but it's certainly lining up for that. Here's the history of the Fannie Mae loan limits. I always love to cover this. It's just fascinating that, again, literally they were at $417,000 for a very long time. We did not have wage inflation. As we got wage inflation back, they started to raise this loan limit. And you can see that they went all the way from 548 to 647. They raised it 18% in 2022 to account for all the appreciation that we just had and for all the wage inflation that we just had. They're going to be raising Social Security by 8.7%. Hallelujah, mom and dad. Definitely want to get more money coming their way, and they deserve it. They worked very, very hard. So I'm happy to see that we still get Social Security, and I'm happy to see that it's going up by 8.7% next year. So, you know, the markets are trying to adjust to these higher prices that we have, bottom line. And the wages are a lot of why we still are sitting in this high wage inflation that we're in, and just the high inflationary environment that we're in. So we're going to talk about that in a minute too, about hopefully how wages will come down. So we can see how, though, in 2021 the loan limits were $548,000 and $822,000 for a high balance loan, and how in 2022 they went for $647,000 to then $970,000, and how in 2023 again they're expected to go up still significantly. Now let's talk a little bit more about conventional and why conventional for investment and for primary residence. So conventional loan programs allow the lowest down payment requirement with the lowest interest rates for buying a primary residence or an investment property. You can do 30-year fixed loans or adjustable rate mortgages. So we are now doing 5-year and 7-year adjustable rate mortgages for investment property. The rates are not much lower though, right? So you get, normally an ARM product was considered a risky mortgage product, and an investment property is considered a risky mortgage product. So you can't go, rather you can't put those two layers of risk together and have good loan pricing. That's how it was for many years. But now we are seeing, for the first time, I'm seeing ARM financing looking more attractive than 30-year fixed from a rate standpoint. It's still not a very big spread though. You know, you're maybe 0.5% better for an adjustable rate mortgage versus a 30-year fixed. So if you're extremely cash flow sensitive, I still would advise just put more money down and stay with the 30-year fix. That would be my advice. But if you're extremely cash flow sensitive, if you believe rates are going to come down in the next 2, 3, 4, 5 years, no matter what, and you're okay, you know, betting that you'll be able to refinance and do a 30-year fixed at that time, then I can see why people are starting to take adjustable rate mortgages, even to save 0.5% in rate, if you believe that rates are going to come down again in the future. So we've got great ARM rates for investment properties, and we still have phenomenal 30-year fixed rates for investment properties. So my company has their own broker-dealer. We have our own proprietary product, 30-year fixed, that has a better interest rate for investors than your average Fannie Mae rate, and that loan requires 30% down. So if you want to stay 30-year fixed, 30% down is going to get you the absolute best rate, and you need to have a FICO score of above 700, and that's going to get you the best rate on the 30-year. The best rate actually is above a 740 FICO, but as long as you're above 700, you can qualify for that program. And then again, if you're okay doing an adjustable rate mortgage because you believe you'll be able to refinance in the future, then again, those rates now are lower on investment, and they're certainly lower on primary residence as well. Now, these provide the lowest interest rates if you have higher credit. If your credit is below 680, then there's other programs available that I would advise to buy a primary residence. And if your credit is below 680 and it's an investment property purchase, conventional is still probably going to be the best option for you. But just know that your interest rate pricing will be a lot higher. Conventional loan programs, conventional loan programs are very credit score sensitive. A low mortgage insurance costs when you put less than 20% down. So on a primary residence, when you put less than 20% down, you're going to have mortgage insurance. You can buy out the mortgage insurance. It's expensive to do that, but you can, or you can pay it monthly. And the mortgage insurance costs are much lower on a conventional loan than on an FHA loan. So if you have good credit, definitely want to go conventional. And then you can finance up to 10 finance properties using conventional loans. You could even do 10 properties under your wife and 10 properties under yourself. Let's say that you're a doctor, or just for example, a doctor and a lawyer. Each of you could build your own rental property portfolio and essentially get 20 conventional loans if you wanted to do that. And we've had clients do that. But if you're buying together, you can finance 10 investment properties with conventional financing. Okay, and let's just cover the 4 units. So you can buy, this loan limit on the left-hand side is just your standard 1 unit loan limit. Okay, on the other side, you have the high cost loan limit for 1 unit on top. 2 unit, though, you can go to 1.24 million, 3 unit to 1.5, and 4 unit to 1.8. With them increasing these loan limits again for 2023, I would guess, if they raise it 10%, it's going to throw you over a $2 million loan amount for a 4 unit, meaning you will literally be able to buy a 4 unit property on a conventional loan with 25% down and take out a loan for $2 million. So this is pretty cool. I'm blown away that they've gone this high. I always take the loan limits as a good read on the economy and how healthy it is. And if the government stops raising this or goes backwards, that would be a big problem if they went backwards. But, they believe even in this high inflation we're in, that the jobs market is strong enough that even as inflation cools, that we're still going to have, moderate increases in wages, and we're going to keep on putting along. So that's what it tells me when they keep on raising loan limits. And again, they're doing it again. It's already happening. We're already lending at the 715 loan amount limit. That's already been confirmed by the GSEs, which is Fannie Mae and Freddie Mac. So just excited, though, to find out what that 1 unit's going to look like. And we should know that in the next month or two. Okay. Now, another really cool component to conventional mortgages. This is for buying a primary residence. You may have heard of the 2-1 buy down. What this is saying, and I'm going to put my mouse on here, based on a 715 loan amount. Let's say your interest rate today with 20% down is 7%, right? Let's say it's not paying any points. It's just a 7% interest rate. You're paying your standard origination fees for processing and underwriting the loan. You're paying title fees, escrow fees. Let's say you're not paying any points, okay? You're just getting a 7% rate. You can then pay 2% of the loan amount in your buy down fee. Now, the first year of making payments, your monthly payment will be based on a 5% interest rate. Your second year, it will be based on a 6% interest rate. And your third year, it will adjust to your actual interest rate, and your payments will adjust to your actual interest rate. Now, Reed, does that mean that payment at 7% is $47.56 a month? The required payment the first year is $38.38 a month. What's happening to this $918 a month that I'm not paying? Is that going on top of my loan balance of $715? That's what's called negative amortization. The answer is no. That 2% you paid is being held in an escrow account with the lender. And they're simply making up the difference of this payment for you every month. Your loan balance is even going down the same way it would as if you were making this full payment. You're paying principal and interest, just like you normally would. But the difference of this buy down is allowing you to make a payment of $3,838 the first year, then it goes to $4,286 the second year, then on the third year it will adjust to $4,756. What's cool about this program is that if you refinance the loan at any time in the next 2 or 3 years while you're paying these reduced payments, any amount left over will go back to you. So if $5,000 has been used to keep these payments low the first 15 months, and there's still, $9,000 in there, when you refinance this loan to a standard 30-year fixed, if rates go back down, you would get back that money. So this is just a different way to ease into your payments if you wanted to start off with a lower monthly payment and then work up to the actual interest rate over time. And then again, if we get lucky and if rates come down, you may end up getting back that money that you had in there for buy down, and then being able to refinance just to a traditional 30-year fix with a much lower rate. That would be ideal. We don't know if that's going to happen. There's also a 3-1 buy down where it allows you to go 3 years. So let's say you start out at 4.5, and then it goes to 5, and then 5.5, and then it goes to 6. So this is a pretty cool program. There's also a 1-1 buy down that my company's coming out with, and just some of the ways that we're being inventful through this process. You know, you can ask the seller for 2% of the sales price in credit, right, to get the offer accepted. You use that 2% to do a 2-1 buy down, and now you start out with a fixed rate, a 30-year fixed loan, but that you're only obligated to pay a 5% rate on the first 12 months. So there are ways that we're getting around interest rates being much higher, because ARM financing is not much lower in rate. You might be 0.5% lower than a 30-year fix. So there's not this 3% gap or 2% gap when you do an ARM versus a 30-year fix. So again, for that reason, I just love this product. I think it's pretty awesome. We've been using it a lot. The all-in-one loan, this is a first lien position home equity line. You know, if you don't have a loan against your primary residence, or if you don't owe much against your primary residence, a loan like this is phenomenal for being able to access your equity and then buying rental properties with this loan. The way that interest is calculated on a 30-year fix, they calculate, or rather they make you pay most of your interest the first 15 years of the loan. So when you start off making payments, you're paying more interest than principal. And then over time, if you keep your loan for 20 years, you're going to save more money with a lower rate. But because you pay so much upfront interest, a lot of times on a primary residence, if you're only going to stay in it for 5 or 10 years, doing an all-in-one loan is better because the interest is calculated daily and the loan's not amortized on a 30-year amortization. So what that means is when you get your mortgage statement, you're only required to pay interest, and the amount of interest you pay versus the interest you'd start off paying on a 30-year fixed is much lower because it's not amortized over 30 years. So it's a very complicated program. There's a whole website on it, but it's a phenomenal program. I have clients that live and die by this program. So if you haven't heard of it, check it out. Go to allinone.com or contact me with any questions. And this also can be done on investment properties. I still stand by my 30-year fix. I really think 30-year fixed are just a phenomenal way to buy investment properties. But the all-in-one can make sense for investment as well. But I think where I see it being the best play is on a primary residence. VA loans, yeah, you know, if you serve our country, you deserve to have the best loan out there. VA loan requires 0 down payment. You can go to a debt-to-income ratio of about 57%, so it's not capped at 50%. But there's no cap on the amount of loan you can do. You can do a $5 million VA loan if your debt ratios are low enough and qualify with zero financing. We did a purchase for a Marcia Reddick client about 2 years ago. It was like a $2.4 million purchase with 0 down. He got a 2.25% interest rate on a 30-year fix with 0 down with no points. So, you know, VA is just a phenomenal loan program. And depending on the property in this market, the only caveats is if you're buying like a condominium, it needs to be VA approved. But pretty much works on any other property. And again, there's no loan cap. You can do a VA loan for as much as you qualify for. One other thing to note on this, you can do VA financing on a duplex also. So we have a lot of buyers buying our new construction duplexes out in like Seguin, New Braunfels. I've done VA purchases for multiple clients buying as a primary residence with 0 down, buying a duplex, living in one side out there. So if you're thinking about, you know, where you want to get some supplemental income on another unit on one side and live in one, the VA loan is just great for that. Or you could do an FHA loan, which only requires 3.5% down, and you could do that on a duplex as well. If you buy with a conventional loan, the Fannie Mae Freddie Mac loan, even on a primary residence, it's going to require 15% down when you do a duplex. So if you want to go minimum down payment and buy a 2-unit property, the only way to do it is with an FHA loan with 3.5% down or with a VA loan with 0 down. FHA financing is great. If you know, let's say you had a short sale or a foreclosure and it was, you know, 4 years plus back, you've gone back up on your feet, things are going great again, you know, you want to buy your next house, you know, you can buy with an FHA loan. The rates are still good. And the product overall is still a good loan product. It's just you want to try to go conventional first. If you can't qualify conventionally for a Fannie Mae Freddie Mac product, then you'll want to try FHA. And FHA is for primary residence only, and so is VA. So there's no investment property financing allowed on VA or FHA. But you can buy using one of these loans, move into the property, live there for a while, move out, and then do it again, right? We have lots of clients that have done that. I suggest living there for 2 years. Okay, because then you get some better tax benefits, but talk to your CPA about that. Okay, jumbo financing is any loan amount over $970,800. Now, we can actually do a jumbo loan for any loan amount above the national conforming loan limit. So what that means is any loan amount above $715,000 for 2023, any loan amount above that is truly what's considered a jumbo. If you're in a high-cost market like Orange County, yeah, Fannie Mae will lend over $1 million here soon. So technically, any jumbo, like super jumbo, is going to be above that amount. These rates on jumbo financing are lower than conventional Fannie Mae financing. It's harder to qualify for jumbo loans. They want to see you have 6 to 12 months of reserves. Excuse me. They generally want to see that your debt to income ratio is below 43%, but we have them available to 45%. And then they generally want to put 20% down on these types of loans. But really, a jumbo loan will have the absolute best rate. It's just harder to qualify for it. So if we've got to keep the rate as sharp as possible, we can do this all the way down to a 715 loan amount. Yeah, we can lend to $3 million is the average max for a jumbo loan is $3 million. Oh, that was me at 19, just doing what I love. It's when I worked for American Direct Mortgage. They were one of the mortgage companies at the time with Marsha Reddick. And yeah, I've just been, I never looked back. I've always had a really, really big passion for real estate and for finance. I love numbers and I love the power of leverage and what it does for middle class America. You know, I grew up very middle class and it's already done so much for my life. So man, if you want to be able to retire one day, buy properties the right way, hold them as long as you can. I think you'll get there just fine. Down payment requirements for investment property. So you can actually do 15% down on an investment. The loan pricing is atrocious. And even 20% down, the loan pricing is not good. We can do the private label security program though with CMG with 20% down. So believe it or not, our 20% down is really great versus what's out there. But just be prepared to pay points in this market. Points refer to paying a percentage of your loan amount in addition to your standard loan fees. So if you Google Wells Fargo mortgage rates today, just Google that, and then you click on the rate that they're offering, and you look in the fine print on the next page, you'll see most of these are being quoted with 25% down on a primary residence. They don't really have investor rates on there. But most even primary rates being advertised are with 25% down. And then when you look in the fine print, it's charging a percentage of your loan amount in points to get that rate. And the reason why you're seeing more points being charged right now is if you fund a loan as a lender and on the secondary market you were to buy that pool of mortgages and you have to pay a premium for that. Well, and then those mortgages all get refinanced 7 months from now or 6 months from now or even 9 or 10 months from now because rates happen to go back down. You're going to lose money buying that pool of mortgages, right? So that's how bond trading works in the secondary market. And so a lot of these loans that are being originated today, there's no demand for them on the secondary market. And so for lenders to safe haven their loans to begin with, you're just seeing premiums being charged. It's very hard to get away with not paying points and even get a rate today, much less a good rate. So we were really big on trying to get a deal in this market. Like there needs to be a deal. Rates are double where they were at. There's just got to be a deal. Right? And it's not just, oh, great, I can actually buy a property now. There's some inventory. I still want to get a deal. So it's a great time to ask for seller credits. Ask for 2% of the sales price to help you cover points. And so you can still get a good palatable deal and then put enough money down to where it cash flows if you're buying an investment, or if you're buying a primary, put enough money down if you can to get a payment that makes sense and get into the property. And then in the future, you know, still make sure you can make all these payments. Like, we don't know that we're going to be able to refi again. Nobody knows that for a fact, but rates tend to follow inflation. I'm going to show a slide on that a little later. And if they do come back down, you should be able to refinance to a lower payment in the future. So again, building rental properties though right now, 25, 30, 35% down. Just be willing to do that so that you can get cash flow. Or, you know, find a property that you can get 10 or 15% below the market, and then the rate doesn't matter as much. So what you need to know to get to 10 finance properties is you got to have a FICO score of 720 or plus. So always try to keep your credit scores up over the years. It's super, super important. You never know when you'll need to tap into equity in a home. You never know when that great deal will come across that you need to be prepared for. So by keeping your credit scores up, trying to keep your amount of consumer debt low, always making your mortgage payments on time, super, super important to be able to build that portfolio over the years and get to 10 finance properties or more. Max debt to income ratio of 45%. And you want to have 6 months of principal, interest, tax, and insurance and reserve for each property. You need that to be able to qualify. And then this just talks about the type of loans that are available to get to 10. You can do 15 or 30-year fixed after you get 7 finance properties. So there's no ARM financing above a certain amount when you have a certain amount of properties. And this is part of what we do when we pre-qualify you, is we'll be able to tell you how many more you can buy and with what type of product. And then just a few frequently asked questions are, when I start to buy rental property, how does the rental income coming in off that property play into the deal? And we can take 75% of whatever the projected rent is going to be. When we order the appraisal, it's going to have 4 or 5 other comparable properties like the one you're buying, and it's going to show what they're rented for. And then we can take 75% of that average rent, and we can add that onto your income towards qualifying. And then when your properties are on your taxes the following year, then we need to go off of the income on the tax returns minus the expenses. We can write some of those expenses back into the income, and we probably end up with about 70% of the rents on average if your property is leased for the whole year. So that's how it plays out once it's on your tax returns. Okay, so if you can't qualify for conventional financing, this is an example of where you would find Marshall Reddick's private rates on their website. You click on the Borrow tab and click on Loan Programs, and it'll take you right there. But, you know, the rental loans are phenomenal, renovation loans, bridge loans. They just did a bridge loan for a client of mine. They got it done in 5 days. Unbelievable. I did supply a copy of the appraisal, and we were able to get the purchase contract over to them, and they were able to fund it in 5 days. So, and the LTV was, I think, about 60% LTV. So just a beautiful loan, and they put it right in the mortgage fund. So you could go in and look at that loan right now through the website by clicking on the Invest tab, click on Mortgage Fund, and you could scroll down and see all the different loans that the fund owns, where they're located, what their loan to values look like, what type of loan that they are. So just the transparency in Marshall Reddick is why I personally, as an investor, feel so comfortable investing my own money with Marshall Reddick. And they manage 5 of my properties. I have over 7 figures in their mortgage fund. I mean, I eat, sleep, and breathe them, and they don't let me down. So transparency, like, you're not always going to get the answer that you want, but you want to get the answer, and you want to know what it looks like, and you're always going to get that with Marshall Reddick. So kudos, guys. Okay, let's talk a little bit about interest rates. Interest rates affect cash flow. You know, that's why we've always showed this slide for years and years. You know, every 1% rise in rate affects 12% of your cash flow. What have rates done this year? They've more than doubled now. They're at a little bit over 7% nationally as an average. So started the year at, you know, a little bit over 3, and now they're at about 7%. But you guys, I love showing this slide because they're just at the average where they have been, you know, since, you know, the 1950. It's very hard to find a slide that actually goes all the way back, but if you go all the way back, interest rates, the average has been 6.67%. So we're riding at about the average right now of where 30-year fixes are at. We're riding right around where we were at in 2005, 6, 7. So what have they done this year specifically? So this is the Fannie Mae 5% coupon. It's the most closely traded mortgage-backed security in relation to the loans that have been funded this year. If you look to the far left over here, you'll see this 100. This 100 represents where the 5% coupon was trading and above. We are actually trading on the 6% coupon right now, but I wanted to show a graph of the 5% because it more closely correlates to how rates have moved this year. But we're actually trading on the 6% coupon somewhere in nowhere land, about 325 basis points below this. Now, every one of these little candlesticks is 1 day of trading, Monday through Friday. It's open during the same days as the stock market. Green is investors were buying this bond, right? Causing the bond to appreciate, driving down the yield. So as this goes up, rates actually go down. As this goes down, this is investors selling the bond, causing the bond to depreciate, which drives up the yield and makes rates worse. This is in November of last year, moving into December, when the Fed told the markets they were very, very concerned about inflation. Wage inflation, core inflation, personal consumption expenditures, whatever reading you want to look at, consumer price index, all of these indexes were looking like inflation was no longer transitory and it was becoming deep-rooted in our society. It's very freaky. So you saw one more last little bit of appreciation in bonds where we didn't fall off a cliff for a few weeks. And literally, as you got into the new year, if you look at the 4% coupon, the 4.5 coupon, the 3.5 coupon, the 3% coupon, those were going like this. They were already selling off a lot. The 5%, there was still some demand. And then you saw right here, this is when we had when Russia invaded Ukraine, right? Already we saw oil prices start to spike. Then we saw that they stayed there. Oil prices went to over $100 a barrel and stayed there for months. Okay, we started to get tremendous inflation. The cost to produce went up a lot, over 10%, stayed there. And right about here is when the markets thought that inflation had peaked. This is when oil was over $120 a barrel for an entire month, and it finally started to come down. It finally started to subside. And all of July, actually, oil prices were they were like sub $100 finally, right? And then we even hit like $80 a barrel, 80, 85 a barrel right here. And this is when the market started to realize that we're probably going to have another peak of inflation, and oil prices going down doesn't just solve everything, right? We still have too many available jobs. Wage inflation is way too high still. And right around here through here is when the markets were just waiting to get August data. That data looked much stronger than expected. Inflation had still not cooled down. And then even throughout September, we started to notice that the amount of available jobs, that number was going down, but not going down nearly fast enough. Wage inflation still just too strong. And then we took another leg down here. Along this time also, the Fed had started to dump all their treasury notes onto the market, causing the 2-year, the 5-year, the 7 and the 10-year treasury note to go up dramatically. You had the Bank of England issue that happened where they're, putting people in place to start doing tax cuts and do quantitative tightening at the same exact time. You don't want to do something to spur growth when you're trying to slow down the market. Liz Truss was recently fired, and they put somebody else in place he's actually for raising taxes, not for cutting taxes. Cutting taxes is great to spur growth, but it's at the wrong time. Right now, we need to slow things down. So you're starting to see the European markets balance out a lot since Liz Truss was let go. And that's now helping our bond markets over here. You can see the last couple days, we've had a lot of appreciation in mortgage-backed securities. Rates have improved about 0.25% from their worst level when we were in no man's land over here. But capital markets are still having a very, very hard time right now. The market doesn't know, what the Fed is going to do 100%. They can only guess at this point until we get this Friday's data. So before we go into that data, I want to talk about what has caused rates to go up so quickly, and then what's the Fed saying. So inflation caused by Russia's invasion of Ukraine is a big part of this. The Fed's no longer purchasing mortgage-backed securities, so they're no longer buying this debt, right? For years and years, they were propping up the market by creating liquidity for this type of debt. They were buying all of it that they could every month, and then the rest of the market was following what the Fed was doing. Large hedge funds, large institutions, other central banks were buying this debt also. But once the Fed backed off and was no longer buying, there's just been no demand for mortgage-backed securities. So, but you're not seeing the Fed sell mortgage-backed securities. When someone pays off their loan, they're just not using that money to reinvest it back in to mortgage-backed securities. That's their form of quantitative tightening. In the EU, they're actually selling their mortgage-backed securities. But we got clarification on that. They're only selling their short-dated bonds. So they're 2-year, they're 5-year. They're not selling their long-dated bonds. That's going to help the housing market. That's helping rates today and yesterday. That data, since last Thursday, I think we got that data, has been helping interest rates find a bottom just right there. And because even our own government is not selling these mortgage-backed securities that they're holding. They're just not buying more of them. So Fed has been selling their treasury notes to the market, causing more supply versus demand. You guys, they've been dumping treasury notes on the market for the last 6 months. Since they announced, actually the last 5 months, they've been dumping. And that's why they're just totally controlling this market right now, trying to slow stuff down. That's what gives me a lot of assurance. This is a Fed-controlled recession 100%. Inflation's running way too hot. They need proof inflation is cooling. Okay, we still don't have, this is what threw us off last month. The Fed's target for growth is 2%. Currently, we're sitting at 4.4%. We had a 0.6% uptick from August through September. If you strip out cost of goods and increase, so if you take out the increase of goods, I think it was up 1%, and then you strip out food and energy, inflation grew still by 3% from August through September. That's a 3.6% annual rate. That's far ahead of the 2% that the Fed wants to see. And they've already done however many rate hikes. So, there could still be a ways to go here. And it's because of that uptick that we got last month. That's what scared the hell out of the markets. That's why rates took another leg up. As you can see on this chart, I mean, literally the September data the August data for September just was not good. And then you saw it again. It just was not good throughout September. And it's directly related to PCE. And we're going to get PCE on Friday. We're going to get personal consumption expenditures on Friday. And hopefully we see that it's not above expectation. If it's above expectation, rates will take another leg up. If it's at expectation, the Fed will still hike rates next week, but probably not by too much. They might only do 50. Bank of Canada only hiked 50 basis points today instead of 75, the market expected. I still think they're probably going to hike 75 basis points, but if they did hike 50, if PCE came in a little lighter than expected, and they only hiked 50, that would be phenomenal for interest rates. And then we may even be moving into more of a patiently waiting approach by the Fed. This is wishful thinking, though, right now, and it's a fool's game right now to call it. I think it's probably going to keep getting a little hotter, and you're going to have a little higher rates. But we'll see what happens this Friday. Now, this is one of the most important graphs in this whole presentation. The line on the bottom is the 12-month lagging CPI inflation rate. So this basically is just the consumer price index. It's inflation as we know it. It's everything that affects us. You can see that 30-year fixed mortgage rates are the blue line. 30-year fixed mortgage rates have basically followed inflation, okay, for as long as we know it. Right here, you saw CPI tick up a lot. Well, you also now have 30-year fixed mortgage rates have ticked up a lot. I think I have a graph. There it is. So there you go, 7.5%. We're currently at 6.94%. Okay, this is through the week of 10/20. So again, you can see that right here, just like you see on this chart, it is literally mirrored what inflation does. So when is inflation going to come down? Well, let's not talk about when. Let's talk about what happens when it does come down. Let's look at history so we can get a good idea of what it does. So the Fed fund rate, that's the rate that they've been hiking, right, to slow down growth, to slow down job creation and get employers to stop hiring people, and so that there's less available jobs and that there's less wage inflation. The Fed fund rate before COVID was 2 to 2.25. The Fed fund rate after COVID hit the U.S. went down to 0. Fed lowered it to 0. The Fed fund rate now is 3% to 3.25. Now, what was the average 30-year fixed mortgage rate before COVID? So when the Fed fund rate was 2 to 2.25, the average mortgage rate before COVID was an issue, by the way, was 3.625% in about January, February of 2020, with a 2 to 2.25 Fed fund rate. In 2017, we had tax reform, and corporate taxes went down dramatically, and there was a windfall to employees from their employers, and you saw wage inflation go over 4% that year through 2017 and in through 2018. And it was far above the Fed's 2% that they wanted to see. So they raised their federal fund rate. They raised that. They were at, I think, 1/4 to 1/2, and they raised rates 4 times at every live meeting. A live meeting is when they basically tell the markets that if we're going to hike rates this year, it's going to be at one of our live meetings. They're generally quarterly. This year, every month is a live meeting, to give you an idea of the volatility we're in, right? Every month is a live meeting. Well, back then it was quarterly, and they hiked interest rates at every quarter. And as a result, you started to see the effects of that wage inflation, that extra money in the economy started to burn off. Higher interest rates slowed things down. And then all of 2019, rates came down slowly. And by the end of 2019, interest rates were about a 3.875 to a 4%. In 2018, they peaked at about 5.25%. So they had gone from the high 3s to 5.25 to slow things down. And then they slowly came down through 2019. And when inflation was at a normal rate, 30-year fixed rates were able to be not too much higher than the federal fund rate. Whereas today, because we are in such a hawkish environment with the Fed, because we don't know when they're going to stop hiking, we have an idea, but we don't know exactly when because the data has been so up and down. That's left the bond markets in a very, I would say, artificially higher than they would be with the Fed fund rate at 3 to 3.25 with inflation under control. I don't think they'd even need to be this high. They would be able to actually lower it. But when you have the Fed stating that they are no longer purchasing mortgage-backed securities, they're dumping their treasury notes on the market, and they've raised the federal fund rate over 300 basis points in 6 months, that's going to shock the bond markets, and you're going to have higher rates than expected. So I think a lot of what we already have for rates are reflecting the Fed hiking one more time, but I don't think that they're reflecting the Fed hiking 2 or 3 more times. So that's what leaves things a little bit open-ended. Now, this is the most important part of this is, what is the average 30-year fixed rate right now? It's 7%. What was the unemployment rate before COVID? 3.7. Today we're at 3.6. And before COVID, we had 7.5 million jobs available. There's a report called the Job Opening and Labor Turnover Survey. It's called the JOLTS report. It shows you how many available jobs that there are in the United States. That reading went from 11.2 million to 10.5, then back above 11 million, and then now this last month it came down to 10,050,000, which was great. It showed that employers are starting to fill their positions. There's less hiring going on. We want less available jobs versus the amount of available workers. That way, you know, the guy that's at Google where Facebook's trying to hire him, they're not getting him to leave Google by giving him 20% more pay. That guy doesn't have a job right now, and he's just getting hired onto Google because he needs a job, and Google's offering him 10% less than he was offering the last guy because the labor market's tightening. There's less available jobs. That's why they're raising the federal fund rate. They want to slow down job creation. There are 10 million unfilled jobs right now. We need that number to be closer to 7.5 million. and we need this unemployment rate to be closer to 4%. So this is part of the problem that's not worked out yet. And then consumer prices and food increases, that's just natural. I mean, that they can't control. But what they can control is this, and they haven't been able to control it yet through these rate hikes. At least we haven't seen it yet. So that's what's leaving like this big question mark up in the air about interest rates right now. So, before I move on, I want to note how strong the real estate market is and how strong it has stayed even though interest rates have doubled this year. That statistic I gave you, that 62% of all Americans are on a 30-year fix below 4%, that is keeping a lot of inventory from hitting the market. People, and if they can't sell for the price that they want, they're starting to just rent their property instead. They can get positive cash flow by renting it, and then they just go buy a new property. So we're seeing that happen, and that's actually causing the rental market to get a little bit more saturated. You'll probably see the rental market soften a little bit, but that's also going to be in an ebb and flow, because before you know it, you'll get more demand. People have to rent. Those properties will get eaten up. It's just the time of year we're in right now is very interesting. If you're looking to get a deal, I think there couldn't be a better scenario right now. You could have more inventory. That would be better. But with interest rates as high as they are right now, and if somebody's got to sell their property and there's less buyers on the open market, I think there's no better time to get a deal than right now over maybe the next 6 months. Maybe we start to see some more price declines. We're already seeing price declines nationally, but again, we're still seeing year over year real estate's up 13%. Case-Shiller Home Index just came in 13.1% over the last 12 months. Month over month, it's down 0.7%. Market was only expecting 0.3 or 0.4, so almost double what the market was expecting. These interest rate hikes are hitting values. They're starting to hit values, but we're not falling off a cliff. And a lot of it could just be seasonality. Less people are buying this time of year, and sellers that can't get the price they wanted, they've taken their home off the market, or they've turned it into a rental property. So again, like prices, it's about, if you want to get a better deal right now, be the guy to go and offer 10% below with a smoking offer, ready to go, fully approved, or buying in cash, and place the offer. You don't have to wait for the market to go down. Make the market go down. Go write a lower offer, So that's really the market that we're in right now, and it'll be interesting to see how things shake out over the next couple weeks. I send out a weekly market update. Every week goes out on every Saturday. It's just very to the point information. So if you guys want to be added on that, let me know. And send me an email, send me a text, and we can add you on. That goes out again every Saturday morning. And hopefully we start to see inflation cooling. I think we all know now that interest rates have a lot to do with the economy and jobs. Those are, I think, the two most important parts of the economy that help appreciation and drive appreciation. And I think that at some point in the future, as you have lower interest rates, you'll probably get more buyers back to the table. And I think that the times that you were able to get a great deal, you'll be getting a deal or you'll be getting the market. But you certainly won't be able to shake the tree like you can right now and probably over the next 6 months. So again, one more time, like YCMG, refi incentive plan. If you buy this year, we will cover the cost to refinance in the future. We specialize in investment property financing and in primary residences. And we're a very, very stable company. We're still going to be here. I think you'll see a lot of mortgage companies go out of business over the next, 6 to 9 months, maybe even over the next 3 months. I hate to see that, but at the same time, it's definitely going to add. There's going to be more people in the future that need mortgage services than I feel the amount of loan officers that'll be available. I'll still be here. Never done anything else. I love what I do. So again, get together with me if you guys want to have a consultation, you want to talk about the future, talk about now, talk about a refi or a purchase, get in touch. And we're licensed in all 50 states. Just some of our reviews, definitely Google my name. This is my partner, Al Rodriguez. We've worked with just a lot of people over the years. Love what we do. So definitely look at who you're working with. Google my name for reviews. And this is my pride and joy. This is my family. And I'm located here in San Clemente. I also work out at the Newport Beach Marshall Reddick home office. I'm up there quite a bit. If any of you guys want to meet in person, we can always do an in-person consultation. And lastly, we're coming up to the Bay Area next month. So me and the vice president of Marsha Reddick are coming up to do seminars on I think the 8th, 9th, and 10th. So if you guys can make it to one of those, if anybody on the call is from the Bay Area, please do come and see us. All the event information is on the website. And thank you for letting me speak tonight, you guys. I greatly appreciate it. I hope you guys got something out of tonight's presentation.
Awesome, Reed. Thanks so much for taking the time and explaining that. That was so good and so much detail. I know that's going to help a lot of folks. So guys, I know that they're just as we're wrapping up, I just wanted to quickly kind of point out some things that could be of interest for those that are exploring our website. So we have our Reddick property rating ebook. So this is something that as you explore our website and as you look at properties, you are going to see a property rating associated with each of these properties. This book goes into great detail of how that's derived, right? There's a lot of factors of how we do this. The main one is going to be the price point, which is based off of the national average. So we go off of a metropolitan statistical area. That's how we derive these properties, and it's on the National Association of Realtors website. So all of this is actually covered in the book, but this is a good thing to review if you are interested in kind of exploring the website a little bit more. As far as, let's see, I'm going to be doing a quick consultation call, just post event. This call could be 1 minute, it could be an hour, whatever it is that you want. But basically, I'm just kind of trying to figure out the who, what, when, where, why, right? I would love to figure out if what brought you to this presentation, if there's something you're thinking about, if you're just gathering info, whatever it is, maybe I could point you into the direction of another presentation or some more info we have. Or if it's answering specific questions about a live situation that you're dealing with, or you're wanting to get pre-approved and ready, right? So maybe if you're not finding the inventory now, well, as the market continues to shift, it's definitely in your interest to prepare yourself by getting pre-approved, understanding your numbers, so that if an opportunity does come about, you have the ability to move and move quickly. So this is kind of what we would cover, what the call may look like, but we can take it any direction that that you'd like. As Reed mentioned, he showed his contact information. Here's my contact information if anybody wants to reach out. Again, I am very much an extension of Marshall Reddick, but I can connect you with anybody in our sphere, right? Whether it's someone that works directly with us, or whether it is somebody like Reed, right? Or somebody external from the company. So please don't hesitate to leverage the resources that are at hand. My phone number and email are there. If you do have any questions, we look forward to connecting and answering those. Thank you guys all so much for taking the time this evening, and also wanted to thank Reed again for the awesome presentation. You did a great job, and can't thank you guys enough. So we'll be in touch soon. Good night.
Thanks, guys.